Welcome to AK Shah's Foreign Exchange Made Easy class. Today is 29th session. Last day I have discussed bear call ladder, bull put ladder, bear put ladder. Today I will discuss covert call, covert put, protective call and protective put. Come to covert call. If an investor have a long position in future contract, he will incur a loss when the market moves downward. But when the market moves upward, the long position in future contract will earn a cash profit. That is, I will mention that here loss and profit will be in cash in future contract. To reduce the loss, if this situation arises, the investor will contract an OTM short call with same maturity as that of future contract, and this complementing short call position along with long future, which is known as covert call. Here, when market weaken, the future position will result losses and short call will not be exercised because the spot price is less than the strike price. So the trader will earn a profit of premium received. The premium generated from short call can offset part of the losses from long future position. On the other hand, if the market becomes strong, long future position will turn profitable and short position may get exercised because spot price is higher than the strike price. So there will be loss and therefore offsetting a part of the profits. Here you see covert call is a combination of two derivatives. One is future and option. First is here in covert call there is long future derivatives and other is long call of a short call option. So if the traders suffer loss from one derivative from the movement of the underlying prices, that will be mitigated from the profit earned by other derivative. You see here, if loss arise in long future contract, when it will arise? When the market weakens. Then the profit earned by the short call option, that will mitigate the losses here and in vice versa. So the combination of the derivatives act here to balance the profit or loss, that is net return. Now come covert put. Here it is also a combination of derivative. Here you see short future position is backed by OTM short put option. Previously you see that in covert call that long future contract is backed by short call option. Here short future position is backed by short put option with same maturity as that of short future contract. To reduce the potential loss that will suffer by the investor when the market becomes strong. If the market becomes strong, then short future position will suffer a loss and then part of the losses can offset by the premium received on short put. At the same time, when market becomes weak, the short future position will turn profitable, but short put position may get exercised and therefore offsetting part of the profit. This is the objective of covert call and covert put. Now come covert call. Here there are two derivatives. One is long future price is 1480 and other is short call option, strike price is 1500, which is little bit higher than the future price, and premium receivable is rupees 20. Now maximum profit is strike price minus future price plus premium receivable, which is 1500 minus 1480 plus 20 is equal to 40. And BP is strike price minus total profit, that is equal to 1460, and loss is unlimited. You see from the diagram, when the underlying price reaches the strike price, then the direction will be upward or downward from this strike price. If the market moves upward, then the profit remains same. That is, quantity wise it is 40, that is the strike price minus future price plus premium receivable. When the market moves downwards, this profit will gradually decrease, and at the point of BP it will be nil, and if crosses it downwards, then the losses will start. It will increase gradually and it may extend up to unlimited level. This is the diagram. Now covert call. Long future price is 1480 and short call strike is 1500. Premium receipt 20. So up to the strike price 20, the trader will earn the premium receipt, because the call buyer will not exercise his right up to the strike price of 1500. If the spot price increase, then the buyer will exercise the right and short call option holder will suffer a loss. Now come the spot or future price. If it is 1300, the long future position, the trader will suffer a loss of rupees 180. That is 1480 minus 1300. And here short call premium is 20, net return will be minus 160. So if it moves upward, market moves upward, profit will gradually decrease. And when it comes to break-even point at 1460, there will be break-even. And if moves upward from this break-even point, then at the point of strike price, the profit will be 40, and if it moves upward, the profit will remain same. Here it is 40. So you see here, from the lower point you start here from 1300. From here the loss will be higher. It will be here. Now the loss will decrease when the market moves upward from this point, and when it reaches the BP, it will be nil. And if crosses the BP, the profit will start, and at the point of strike price, it will 40, and it remains constant when the market moves upwards. Next come covert put. Here there are two derivatives. One is short future at rupees, so future price is 1500, and short put option strike price is 1470. Here the strike price is little bit less than the future price. Premium receivable is rupees 50. Maximum profit, since future price is higher, so future price minus strike price plus premium receipt is equal to rupees 45. Break-even point strike price plus total profit is equal to 1550, and loss is unlimited. Now come the strike price 1470. From here, if the market moves downward, the profit will be same, and here it is 45. And if it moves upward, the profit gradually decrease up to the point of BP where it will be nil, and it moves downward, upwards further, then the loss will start, and it will increase and may extend up to unlimited level. Covered put table. Now short future price is 1500. Short put strike price is 1470, premium receivable is 50. So for put option, up to the strike price 1470, the put option holder will earn the premium receive 15. And you see, when the spot price or future price is 1300, short future price will earn a profit of 200 because it is less than the future price, because it is short future. And here you see that 170 is the loss from the price, spot price and strike price, and 15 is the premium receipt. Net loss will be 155 and net return will be 45. And if moves upward 100, it will be 45. And when it reaches the strike price 1470, it will be 45. If it moves upward from this strike price, then the profit will gradually decrease, and at the point of BEP, the profit will be nil. And if it moves further upward, crosses the BEP, then loss will start and gradually increase, and it may extend up to unlimited level. Now come protective call. To reduce the potential loss of a trader having short future position, he will buy an OTM call option with same maturity as that of future contract. It is just opposite of the covered call, where covered call is a long future position with short call option. Here it is short future position with long call option. And this strategy having the existing short future position in underlying securities and a long call position is called protective call. If the market strong, the future position will result in losses and the long call will be exercised. The payoff from long call partly offset the losses of the short call holder. On the other hand, if the market becomes weak, the short future will turn profitable and long call will not be exercised, and the loss of the long call will offset part of the profit. The loss of the long call is premium paid. Come to protective put. The combination of existing long future position and long put option. The covered put strategy, there is short future position with short put option. Here protective put, long future position with long put option with same maturity as that of future contract is called protective put. Here the market becomes, if the market becomes weak, the future position will result in losses and the long put will get exercised. The payoff from long put partly offset the losses of the long future position. On the other hand, if the market becomes strong, the long future will turn profitable and long put will not be exercised, and the loss of the long, that is premium paid, will offset part of the profit here. Now come protective call. Short future, here there are two derivatives. One is short future, price is 1480, and long call. Strike price is 1500 at the rate of rupees 20, that is premium payable. Maximum loss, strike price minus future price plus premium payable, that is rupees 40. And BP is strike price minus total loss is equal to 1460 and profit is unlimited. If you come to the strike price 1500, from here you see if the market price moves upward, then the loss will remain same, that is 40. And if market moves downwards, then the loss will gradually decrease up to the point of BP where it is nil, and if it crosses the BP, the profit will start and gradually increase and may extend up to the unlimited level. Now come the table. Short future price is 1480. Long call strike is 1500. Premium paid is 20. So up to the strike price of 1500, the buyer will suffer a loss of premium paid rupees 20. And if it exceeds 1500, then loss will gradually reduce and it will be profitable when the underlying price increase. Market moves upward. Now come the spot price or future price. It is 1300. So in short future position, it will be a profit of rupees 180 because the future price is less than the spot future price 1480. And next year it is loss 20, so net return will be 160. That is profit. Now the market moves upward, then profit will comes down and from 160 to 60. When it reaches the point 1460, there will be the break-even point, that is no profit, no loss. If it moves upward, then loss will start from the strike price 1500. And if it moves upward, the loss will remain constant. That is, here it is 40. Next come protective put. Here long future price is 1500. Long put option, strike price is 1470 at the rate of 15, premium payable. Maximum loss is future price minus strike price plus premium payable is equal to rupees 45. Now BEP point, BEP is strike price plus total profit, here it is 1515. Now come to the diagram. When the underlying price reaches the strike price, here it is 1470. Then if the market moves downwards from this strike price, the trader will suffer a loss of 45, which is constant. And if it moves upward from this strike price, the loss will gradually decrease up to the point of BP, and if it crosses BP, the profit will start and it may increase up to the unlimited level. Come to the table. Now long future price here is 1500 and long put strike price is 1470, premium paid is 15. So here it is put option up to the strike price of 1500 from the lower side. The premium will be from the higher side, from the higher side the premium paid will be same, that is 15. And come to the point of BEP 1515. Here the BEP reached, and if it moves upward, the market moves upward, then profit will start and gradually increase, and it will be extended up to unlimited level. If it decrease from this break-even point, the loss will start and gradually increase, and when it reach the strike price 1470, then it will be remain same 45. Here it is not shown 1470. From 1470 the loss will be 45 and it will be constant when it moves downwards. You see here, when the market moves from the strike price 1470, then the loss will remain same constant 45. Here it is not shown in 1470. Now you see one thing, that in covered call or covered put, the strategy goes from fixed profit zone to loss zone. If you see the covered call and covered put, you see the profit zone. From profit zone it will extend to the loss zone, and if it comes to protective put or call, you see from loss zone to the profit zone, and this profit may extend up to the unlimited level. Now come future pricing. Future pricing of an underlying asset such as currency, stock, bond and commodity is very much useful to the buyer and seller to purchase or sell the underlying asset at a future price and on a predetermined date. But it is difficult to design a single methodology for calculation of pricing of future contract, because different assets have different demand and supply pattern, different characteristics and cash flow pattern. There are two popular models of future pricing. One is cash and carry model and another is expectancy model. Now come cash and carry model. In cash and carry model, the theoretical future price is calculated that will be fair to both buyer and seller of the contract if the spot price and the cost of carry are known. Then the fair value of future price is equal to spot price plus cost of carry from today to future date. The main component of cost of carrying or a financial asset from today to future date entails different costs like transaction cost, custodial cost, financial cost, that is interest. And whereas in commodities it will be included the cost like warehousing cost and insurance cost. The cost of carry model is expressed as, in currency derivative, I have already discussed that future price is equal to spot price multiplied with 1 plus RD, that is RD is interest in domestic country, divided by 1 plus RF, that is RF is interest rate in foreign country. But here in the security, that is equity, bond and commodity in general, the cost of carry model is equal to F is equal to S plus C, that is equal to F is equal to future price, S is equal to spot price, C is equal to cost of carry. For example, if the cost of 10 grams of gold in the spot market is rupees 60,000 and the cost of carry is 12% per annum, the fair value of 4-month future contract will be F is equal to S plus C, that is equal to 60,000 plus C is cost of carry, that is equal to 60,000 into 12%, it is per annum, into 4 months, divide by 12 into 4, that is equal to 60,000 plus 2,400 and 62,400. In case of annual compounding, the fair value of future price contract can be calculated as F is equal to S into 1 plus R to the power N. F is equal to future price, S is equal to spot price, and R is equal to cost of financing in percentage annually compounded time. N is equal to, that it will be small n, time till expiry of contract number of years. If the value of R, that is the carrying cost, is compounded, interest rate compounded m times in a year, the fair value of future contract can be calculated as F is equal to S into 1 plus R by M to the power M into N. For example, if the cost of 10 grams gold in the spot market is rupees 60,000 and the cost of financing is rupees 12% per annum, compounded monthly, you notice here monthly, that is M is equal to 12. Fair value of 4-month future contract will be F is equal to S into 1 plus R by M to the power M into N. That is equal to 60,000 into 1 plus 0.12, that is 12%, divided by 12, that is monthly compounded, to the power 12 into 4 by 12, that is 4. F is equal to 60,000 into 1.01 to the power 4 is equal to 62,436. Similarly, for semi-annual compounding, M is taken 2, and for quarterly compounding, M is taken as 4. For example, in the last problem, the 60,000 is the spot price of the gold and 12% cost of financing is 12% is compounded semi-annually. The future value price will be 60,000 into 1 plus 0.12 by 2, that is M is equal to here 2 to the power 2, that is equal to 60,000 into 1.06 to the power 2, that is equal to 67,416. For quarterly compounding, the future value will be 60,000 into 1 plus 0.12 by 4 to the power 4, that is equal to 60,000 into 1.03 to the power 4, that is equal to 67,530. Today I stop the class here. Next day the future pricing will be continued. Thank you.